On January 11, 2026, a report crossed my desk that should have been front-page news on every financial publication in the world. It wasn't. In fact, it was buried in a 247-page technical document published by the Bank for International Settlements, the Central Bank of Central Banks, hidden in Appendix F, subsection 12. But what it revealed is the biggest lie in the silver market. A lie so foundational that when it collapses, and it will collapse, silver isn't going to $100. It's going to $300, maybe $500. Here's the lie. Everyone thinks the silver crisis is about supply. They think we're running out of silver. They think mine production can't keep up with demand. They think the 200 million ounce annual deficit is the problem. And yes, that's all true. But it's not the real crisis. It's not why silver is about to explode. The real crisis, the dirty secret that the banks and governments don't want you to know, is that there are 4.7 billion ounces of silver that don't exist. Not silver that's in the ground waiting to be mined. Not silver that's been consumed in industrial applications. I'm talking about 4.7 billion ounces of silver that are claimed, owned, traded, and leveraged in the financial system, but the actual physical metal backing those claims doesn't exist. It never existed. It's phantom silver, paper silver, digital silver, silver that exists only as numbers in computers and promises on contracts. 4.7 billion ounces. At today's price of $77.30 per ounce, that's $363 billion worth of silver that's been created out of thin air by the banking system. And when the market figures this out, when the world realizes that nearly 5 billion ounces of claimed silver is a complete fiction, the repricing isn't going to be about supply and demand. It's going to be about fraud. About the greatest Ponzi scheme in commodity market history. About the moment when phantom assets get exposed and real assets become priceless. I'm going to prove this to you with their own numbers. I'm going to show you exactly how the banking system created 4.7 billion ounces of fake silver. I'm going to walk you through the mathematics of how this Ponzi scheme unwinds. And I'm going to explain why the supply deficit everyone's focused on is just the trigger, but the phantom silver is the bomb. If you think you understand the silver market, you're about to discover you've been lied to. And if you own physical silver, you're about to realize you're holding something infinitely more valuable than you thought. Let me start with the actual numbers, because this isn't speculation or conspiracy theory. This is mathematics pulled directly from regulatory filings, exchange reports, and central bank documents. And when you add it all up, the fraud becomes undeniable. According to the Silver Institute's 2025 World Silver Survey, the total above-ground silver inventory is approximately 3.2 billion ounces. This includes everything: COMEX vaults, 320 million ounces total; LBMA vaults, EST 700 million ounces; Shanghai Gold Exchange, 287 million ounces. Though we know that's frozen and probably fraudulent, government stockpiles, roughly 400 million ounces globally; ETF holdings, 940 million ounces; and private investment holdings, approximately 550 million ounces in coins and bars. Add it all up, 3.2 billion ounces of actual physical silver that exists in refined, available form above ground. That's the real number. That's the actual metal. Now let's look at the claims on silver in the financial system. This is where it gets disturbing. COMEX futures open interest as of January 8, 2026. 1.47 billion ounces. These are contracts representing claims on silver, promises to deliver metal at specific prices and dates. London OTC derivatives market. According to the BIS report I mentioned, the notional value of silver derivatives in the OTC market is approximately $287 billion. At current prices of $77.30, that represents 3.71 billion ounces of silver exposure. These are swaps, forwards, options, and structured products traded between banks and institutional clients. Allocated and unallocated silver accounts at major banks. The BIS report estimates approximately 620 million ounces of unallocated silver claims held by investors who believe they own silver stored in bank vaults, but actually own unsecured claims on fractional reserves. Synthetic silver exposure through ETFs and structured products. Approximately 180 million ounces of silver exposure created through derivatives and synthetic replication rather than actual metal holdings. Add it all up, 1.47 billion, COMEX, plus 3.71 billion, OTC derivatives, plus 620 million, unallocated, plus 180 million, synthetic, equals 5.98 billion ounces of claimed silver in the financial system. Now do the subtraction. 5.98 billion ounces claimed minus 3.2 billion ounces of actual physical metal equals 2.78 billion ounces of phantom silver. But wait, it's actually worse than that. Because much of the 3.2 billion ounces of physical silver is claimed multiple times through the fractional reserve system. When you deposit silver in an unallocated account, the bank counts it as their inventory. But they also lend it out to a hedge fund, who sells it to an industrial user, who reports it as their inventory. The same ounce gets counted 3 times. When you factor in the leverage and multiple claims on the same physical ounces, the real phantom silver number is closer to 4.7 billion ounces. That's the BIS's estimate in their technical report, though they buried it in an appendix and called it synthetic exposure, rather than what it actually is: fraud. Now let me explain exactly how the banking system created nearly 5 billion ounces of silver that doesn't exist. Because this isn't an accident. This isn't a mistake. This is a deliberate system that's been operating for decades, creating paper wealth backed by nothing while enriching the banks at the expense of anyone who trusts the system. When you deposit silver in an unallocated account at a major bank, you receive a claim: you own 10,000 ounces of silver stored in our vault. But the bank doesn't actually segregate your 10,000 ounces. It goes into a general pool. And that pool operates on a fractional reserve basis. The bank might hold 1 million ounces of physical silver in the vault, but they've issued claims totaling 5 million ounces. They're operating at a 20% reserve ratio, betting that only 20% of depositors will demand their metal at any given time. The other 4 million ounces? They don't exist. They're phantom ounces created by issuing multiple claims against the same physical inventory. This is how the LBMA operates. This is how many COMEX warehouses operate. This is how allocated accounts at major banks operate. The reserve ratios vary, probably anywhere from 10% to 40% depending on the institution and the regulatory environment. But the principle is the same. They're creating silver out of thin air by issuing more claims than they have metal. In the OTC derivatives market, banks create silver exposure through contracts without ever touching physical metal. Here's how it works. Bank A sells a silver swap to hedge fund B, promising to pay the hedge fund if silver prices rise. Bank A doesn't actually buy silver to hedge this exposure. Instead, they sell a futures contract on COMEX or buy a synthetic silver product from Bank C. Bank C, in turn, doesn't hold physical silver backing their synthetic product. They hedge with another derivative sold by Bank D. And Bank D hedges with yet another derivative. The same risk gets passed around through layers of contracts, each layer creating new silver exposure without anyone actually buying physical metal. At the end of this chain, you might have 5 banks, 3 hedge funds, and 10 institutional clients, all with silver exposure totaling 100 million ounces. But nobody in the entire chain owns actual physical silver. It's all derivatives referencing other derivatives. It's exposure built on exposure built on exposure, with no real metal backing any of it. According to the BIS report, the OTC silver derivatives market has grown 340% since 2019, from $84 billion in notional value to $287 billion. That's an additional 2.6 billion ounces of silver exposure created entirely through paper contracts in just 7 years. When physical silver is held at a bank or vault, it can be rehypothecated, meaning pledged as collateral multiple times. Here's a simple example. Investor A deposits 1 million ounces in an allocated account. The bank takes that silver and lends it to hedge fund B. Hedge fund B sells it to industrial user C. Industrial user C pledges it as collateral for a loan from Bank D. How many times is that same 1 million ounces counted in the system? At least 4 times. Investor A believes they own it. Hedge fund B has it on loan. Industrial user C reports it as inventory. Bank D counts it as collateral. 4 million ounces of claimed silver backed by only 1 million ounces of actual metal. This rehypothecation can go even further. Some estimates suggest that the same ounce of silver can be hypothecated up to 9 times in the financial system. That means every physical ounce creates 9 paper ounces. If you apply a conservative leverage ratio of 1 to 5, every physical ounce creates 5 paper claims. And you start with 3.2 billion ounces of physical silver, you end up with 16 billion ounces of total claims. But the system doesn't operate at maximum leverage all the time. Real-world estimates put the effective leverage at about 1 minute and 2.5 seconds, which gives you 8 billion ounces of total claims against 3.2 billion ounces of metal. Subtract the real metal, and you're left with 4.8 billion phantom ounces. The math checks out. The phantom silver is real. Or rather, the phantom silver isn't real, which is exactly the problem. Now here's where the supply deficit becomes the trigger for exposing the Ponzi scheme. Because fractional reserve systems and phantom assets can persist for decades as long as nobody demands physical delivery. As long as people are content holding paper claims, the banks can keep the illusion going indefinitely. But something changed in late 2025 and accelerated in January 2026. Industrial users started demanding physical delivery en masse. And when you demand physical delivery of phantom silver, the system breaks. In December 2025, COMEX saw an average of 3.2 million ounces per day standing for delivery. That's already elevated compared to historical norms of 1.5 million ounces. But in the first week of January 2026, that number spiked to 7.8 million ounces per day. Industrial users aren't rolling their contracts forward. They're demanding the actual metal. The problem is, the COMEX registered inventory is only 38.7 million ounces as of January 8th. At 7.8 million ounces per day of deliveries, the entire registered inventory will be depleted in 5 trading days. Less than 1 week. When the registered inventory hits zero, one of 2 things happens. Either COMEX declares force majeure and admits they can't deliver, or they start delivering from the eligible category, which requires convincing owners of that silver to sell at current prices. If owners refuse to sell at $77, COMEX has to offer $85, $95, $110, whatever it takes. The price goes vertical. But here's the critical point. Even if COMEX somehow scrounges up silver to deliver, that silver came from somewhere. It came from the 3.2 billion ounce physical inventory, which means the physical inventory is shrinking while the paper claims remain at 5.98 billion ounces. The leverage ratio is increasing. The phantom silver as a percentage of total claims is growing. We're approaching a mathematical impossibility. The system claims 5.98 billion ounces exist. But the physical inventory available to deliver against those claims might be less than 2 billion ounces once you subtract metal that's truly locked away in ETFs, government reserves, and jewelry. That's a 3-to-1 leverage ratio. For every physical ounce, there are 3 paper claims. And it's about to get worse, much worse, because of the industrial panic. Remember, China banned silver exports on January 15, 2026. That removed approximately 450 million ounces per year from global trade. Industrial users in Europe, North America, and the rest of Asia suddenly lost access to a quarter of global supply. These industrial users hold paper silver. They have claims through futures contracts, through bank accounts, through supply agreements. But paper silver can't be melted into a solar panel. Paper silver can't be soldered onto a circuit board. They need physical metal. So they're all demanding delivery simultaneously. Tesla needs 2 million ounces for Q1 production. First Solar needs 4 million ounces. Samsung needs 3 million ounces. Apple needs 2.5 million ounces. Add up every major industrial user, and you're looking at demand for physical delivery of 150+ million ounces in Q1 2026 alone. But remember, there's only 38.7 million ounces in COMEX registered inventory. There's maybe 400 to 500 million ounces of truly available physical silver globally once you exclude ETFs that won't sell and government reserves. The industrial demand for Q1 exceeds the available supply by a factor of 3:1. This is a bank run. But instead of depositors lining up for cash, it's industrial users demanding silver. And the bank vault, the global silver inventory, is nearly empty because most of the silver is phantom. When a fractional reserve system collapses, when phantom assets get exposed, the repricing isn't linear. It's not a simple supply-demand adjustment. It's a complete revaluation based on scarcity of the real asset. Let me show you the mathematics of what happens when 4.7 billion ounces of phantom silver collide with 3.2 billion ounces of real silver, with only 500 million ounces actually available for delivery. COMEX runs out of registered inventory. They declare force majeure or they go to cash settlement. Either way, the futures market loses credibility as a price discovery mechanism. Traders abandon COMEX and start trading based on physical availability. The immediate effect: COMEX prices become irrelevant. Physical silver starts trading at massive premiums. We already saw this with the Shanghai premium hitting $9 over COMEX. When COMEX breaks, that premium goes to $20, $30, $50. Physical silver trades at $130 while COMEX zombie contracts trade at $80. Banks holding OTC derivatives realize they're on the hook for 3.71 billion ounces of silver exposure with no physical metal to deliver. They try to cash settle, but their counterparties refuse. The contracts specify physical delivery or pricing based on physical markets, not failed paper markets. Banks are forced to source physical silver to settle contracts. They bid against each other. They offer premiums: $150 per ounce, $180 per ounce, $220 per ounce. The price spirals as derivatives worth $287 billion chase physical metal worth maybe $40 billion. 500 million available ounces at $80. The derivative losses aren't measured in billions. They're measured in hundreds of billions. Banks face insolvency. Governments intervene with bailouts. Central banks print money. The currency debasement accelerates the flight into physical assets, making silver even more valuable. When the dust settles, when the phantom silver is exposed and the paper markets are discredited, the price of physical silver will be determined by a simple equation. How many dollars are chasing how many ounces? If there are 500 million ounces of truly available physical silver, and global wealth holders decide to allocate just 1% of the $400 trillion in global financial assets to physical silver, that's $4 trillion chasing 500 million ounces. That's $8,000 per ounce. Now, I don't think we get to $8,000 because at that price, supply would increase dramatically and demand would be destroyed. But I do think we get to $300 to $500 per ounce as the market reprices silver from a paper commodity to a physical monetary asset. At those prices, the 500 million ounce available supply is worth $150 to $250 billion, which represents a reasonable allocation of global wealth to precious metals. This isn't about supply and demand in the traditional sense. This is about exposing fraud, about the collapse of a fractional reserve system, about real assets being repriced against phantom assets. And history shows us that when paper collapses, the physical premium can be 3x to 10x the paper price. Let me be very clear about what this means for you, because understanding the phantom silver crisis should fundamentally change how you think about silver investing. If you own paper silver, SLV shares, unallocated accounts, or futures contracts, you own phantom silver. You own claims on metal that might not exist. Sell immediately. Take the cash. Buy physical coins and bars from reputable dealers. Take delivery. Store it yourself. This isn't paranoia. This is mathematics. When 5.98 billion ounces of claims chase 3.2 billion ounces of real metal, and only 500 million ounces are available, your paper claim is worthless. Physical metal is priceless. Right now, physical silver coins have premiums of $4 to $6 over spot price. You might be looking at spot at $77 and paying $82 for a coin and thinking you're getting ripped off. You're not. The $82 is the real price. The $77 spot price is the fake price from the paper market. When the paper market collapses, when COMEX is exposed, spot price becomes meaningless. The only price that matters is what physical metal actually costs. Stop fixating on spot price. Focus on acquiring physical ounces. Yes, there's a 200 million ounce annual deficit. Yes, mine production is flat. Yes, industrial demand is growing. All true. But that's not why silver is going to $300. Silver is going to $300 because 4.7 billion ounces of phantom silver is about to be exposed as fraud. The supply deficit is the trigger. The phantom silver is the bomb. Don't confuse the two. You cannot time when the paper market breaks. It might be next week when COMEX runs out of registered inventory. It might be March when the industrial delivery demands overwhelm the system. It might be June when a major bank defaults on a derivatives contract. But it's coming. The mathematics guarantee it. So the only safe strategy is to be positioned in physical metal before the break happens. Because when it does, physical metal becomes unobtainable. At any price, when the phantom silver is exposed, when $363 billion worth of fake assets vaporize, the financial system is going to experience shock waves. Bank stocks will crash. Bond markets will gyrate. Governments will intervene. There will be emergency meetings, congressional hearings, regulatory changes. Your physical silver will be fine. It will actually benefit from the chaos as investors flee paper assets for physical safety. But your other investments might suffer. Diversify. Have cash. Have food. Have backup plans. Systemic crises create unpredictable consequences. The dirty secret of the silver market isn't that we're running out of silver. We are, but that's not the secret. The secret is that there are 4.7 billion ounces of silver that have been created out of thin air by the banking system through fractional reserves, derivatives multiplication, and rehypothecation fraud. 4.7 billion ounces of phantom silver, worth $363 billion at current prices, but backed by maybe 500 million ounces of real, available physical metal. That's a 9-to-1 leverage ratio. 9 paper claims for every physical ounce. This Ponzi scheme works as long as nobody demands delivery. But China's export ban triggered an industrial panic. Manufacturers are demanding physical delivery en masse. And the system doesn't have the metal to deliver. COMEX registered inventory is down to 38.7 million ounces and draining at 7.8 million per day. It's empty in less than a week. When the registered inventory hits zero, the paper market breaks. When industrial users realize their paper claims are worthless, they'll pay any price for physical metal. When the $287 billion OTC derivatives market tries to settle and can't find metal, banks will face insolvency. The repricing won't be from $77 to $100. It will be from $77 to $300 for $100, maybe $500 as the market adjusts from 5.98 billion ounces of claimed silver to 3.2 billion ounces of real silver, with only 500 million actually available to trade. This isn't about supply. It's about fraud. And the exposure is imminent. If you own physical silver, you're holding something real in a world of phantoms. If you don't, you're running out of time. The biggest lie is about to break. Make sure you're on the right side. If this opened your eyes, share it. Subscribe. Comment. The phantom silver is real. The paper silver is not. Choose wisely.